cash flow diagrams. In the engineering economics section of the reference handbook, there's no separate dedicated section for cash flow diagrams, but it's an important idea before you launch into solving an economics problem. To be able to understand what's actually happening, drawing a cash flow diagram can be essential. It can actually be quite hopeless to make progress in an economics problem without drawing the cash flow diagram first. So before we start talking about discount factors and interest rate tables, let's take a moment to go through a couple of examples. And none of these are specifically engineering examples. They're just financial transactions off the top of my head that'll kind of get us thinking about how to draw these diagrams. So let's start with an annuity. And again, you don't have to know about specific financial products. This is just something that we can use as an exercise to draw a cash flow diagram. So on a cash flow diagram, you have time on the horizontal axis. And the first point is year 0. And then you have a tick for every year, although sometimes I won't draw a tick. I'll just draw the arrows straight away. And an annuity is essentially a product where you put down a lump sum. So let's say you're at retirement age, you're 60 years old, and you've got $1 million and you're ready to retire. So in year 0, you hand that $1 million over to a company that's going to provide you with an annuity as a lump sum. And then that company provides you with a fixed annual income for a specific duration. So every year, they're going to give you, let's say, $50,000, and we can draw lots of these little arrows, and let's say they're going to do that for 30 years. So there would actually be 30 of those little arrows all the way out to year 30. And you might say, well, hang on a minute, 50 times 30 is more than $1 million. It's $1.5 million. But there's some interest rate here, there's some rate of return, and there's the time value of money to consider. You're giving up your $1 million right now, so you lose use of that, and they can take that and invest it, and they've only got to give you $50,000 back in year 1, but that money's being sprinkled to you over 30 years. So that's why you have to get more back in the future to compensate for the fact that over time that money is losing value. Because the alternative would be that you could keep that money and you could invest it. But if you're purchasing an annuity, you probably don't want to invest because you're worried about the risk of loss. And this kind of a product can give you the certainty of income. Certainly not financial advice, and I'm not recommending that retirees necessarily get annuities. Just saying that people who purchase annuities, this is the idea that they have in mind. So bringing it back to drawing cash flow diagrams, our goal here is to capture the outflows with down arrows. So this is kind of negative $1 million from the perspective of the person purchasing this product. And then the positive cash flows are drawn up above the horizontal axis. And that's a common theme for all types of cash flow diagrams that we'll draw. So let's take a different situation. Maybe we'll talk about someone a bit younger that's making an investment. And I'll call it investment A because I have another example for this. And let's make it a really simple investment. In year 0, you plunk down 10 grand. And in 10 years, your money doubles. And in the next 10 years, it doubles again. But you don't get any of the money out until the very end. So let's draw year 5, year 10, year 15, and year 20. And in year 20, you get out and be a much bigger arrow. If I were to draw these arrows proportional to the magnitude of the quantity they're measuring, it would actually have to be 4 times larger than this one. In the interest of space, I'll just label it 40K. So that's a good deal. You made about a 7% rate of return for 10 years, doubling your money to 20,000, and then did it again and doubled through once more. So in both of these cases, we have an initial cash outlay in year 0. That's a present value of negative 1 million or negative 10,000. And then we have future cash flows. Here we have individual future cash flows spread over 30 years. So we have 30 of those payments, and that's called an annualized payment. So that's 50K with an N of 30 because it's happening every year for 30 years. This we would call a future payment, and we would use the letter F. So when you have a present value like this, we use the letter P for that. So this would be a P. And when we have the same cash flow over and over again for many years, we call that A. It's an annualized value. And then when we have a future value, we call that F. So you're going to see these variables come up again in the next video when we talk about cash flow factors or discount factors. So it's important to be able to distinguish what each of these cash flows means on the diagrams. Now let's imagine another investor, and this investor doesn't have $10,000 to plunk down straight away, but they do have income, so they can direct a little bit of their income as they work and make money toward an investment. And let's suppose that they're able to put 1,000, let's make it 1K, and they can do that again at the end of year 1, and the end of year 2, and the end of year 3, and maybe they're able to do that for 10 years. So that would be an annualized payment, but it's not an annualized positive cash flow like a revenue, like we have here, the 50,000 coming back. It's below the line, it's negative, so it's a payment. That's why those arrows are drawn down. And then in the future, it could be in the immediate future, like 1 year after the last payment, or it could be any amount of time later. There would be a large, hopefully a large positive return of that capital plus a significant amount of gains or interest if it was a good investment. And we could put numbers to that as well, but that's conceptually the idea of dollar cost averaging, which a lot of investors like to use because it's difficult to time the market if you have a lump sum and figure out when to put your money in the market. Instead, you can buy a little bit at a time over time, and you're guaranteed to get the average price when you use that strategy. And here we have another example of an annualized payment, so we'll use A, and a future cash flow F. Another important convention to be aware of in economics problems and on cash flow diagrams is the idea that all of the costs, all of the payments, or all of the revenue streams, whether it's money coming in or going out, that happen within a year are tallied up at the end of the year and captured in a single arrow. Because it would be too onerous to start thinking about months or weeks or days. There's just too many cash flows and the problem would become excruciatingly detailed. So we just sort of look at it on a yearly basis and say, how much are we putting down right now or how much are we getting right now? And then we summarize each year into the future. So any financial transactions that happen during the year are just tallied up and they're shown at the end of the year. So when we say that this is year zero, and this is year 1, 2, 3, same thing here, 0, 5, 10, 15. This 1 is the end of the first year. This 2 is the end of the second year. 0 is right now at the beginning of the first year. And another example that will help bring that point home is the cash flow diagram for buying a house. If you're buying a house, let's say it's $1 million house, you're making a $250,000 down payment, 25%, so $250K. That's a payment in the present. And the moment you do that, you have $1 million asset that's on your balance sheet because you now own that house, even though you haven't paid for it yet. You have $1 million asset and you have $750,000 of debt. So really you could leave the million off because it's not a cash flow. You didn't receive cash, you just received possession of a house that you now own. So I suppose we can leave that off because we're not going to show an arrow for the debt. Maybe it doesn't make sense to show the arrow for the asset either. So we'll just focus on the cash flow. And then you make a mortgage payment. You make a monthly mortgage payment, but again, we're not going to deal with things on a monthly basis. We're going to deal with them on an annual basis. So we'll tally up those 12 monthly mortgage payments for the year into the annual amount. So let's say it's a $5,000 mortgage payment and you have 12 of them. So every year it's going to be $60,000 worth of mortgage payments. And that's principal and interest. So the interest is baked into that number. And let's suppose it's a 30-year fixed mortgage. And that's really the whole story there because all of the cash flows are negative. You bought something, you spent money, it's all costs. So all of the arrows are down below the line. There's nothing positive offsetting that. The only positive thing is that you got a house. And when you get to the end, that $1 million asset will still be sitting on your balance sheet and the debt will have been reduced to zero. And if there's any appreciation, then of course that'll be reflected in the value of your home as well, which is not liquid, but it's still value. So again, what we want to notice here is that we're not solving specific engineering economics problems. We're just understanding how to draw a cash flow diagram for different types of financial transactions, of which there could be many. And I'll do one more and leave it at that. I think you probably can extract the main principles from these examples. Imagine starting a small business. And in this business, let's imagine that you don't borrow any money to start it. It's just bootstrapped from the bottom up. You start producing something that doesn't cost anything to produce and people want to purchase it, or you start selling your time or your services where there's sweat equity in it. So you're working on something, but other than your time, there's no cost to produce those goods and services. So if that's the case, then there's no expenditures, nor is there any income in year zero because you haven't sold anything yet. And you project that in the future, in year one, you're going to make a certain amount of money, and then you're going to attempt to grow the business. So you believe that you can grow the business by some amount for year 2 and even more in year 3. And that over a period of, let's say, 10 years, this is what your revenue could look like. I'm not putting any specific numbers to this. I just want to illustrate the principle here. We can deal with those 10 revenue streams as individual cash flows in the future. And using an interest rate, we can discount those back to a present value. That's something we'll cover in the next video. But business is not just revenue, there's also costs. And the more you make, the more you probably have to spend. So as soon as you start making money, you probably also have to spend some money. And the chances are the costs are going to scale with the revenue, hopefully not to the point where they're eating up the revenue, but they are going to increase, and maybe that's also linear. So let's let this be the revenue, and let's let this be the expenses. And then the difference between the revenue and the expenses is the profit before tax. So profit before tax would be revenue minus expenses. Once you get the difference between the revenue and the expenses, that's the pre-tax profit, and then you apply the tax rate to that to calculate the taxes. The after-tax profit is the revenue minus the expenses and the tax. So let's put some tax on there as well. And as you have more profit, you're going to have more taxes too. So that number is also going to scale over time. So you could find the difference like this, the after-tax profit, and then discount those future cash flows back to the present value in year 0 to find out what it's worth today. Or you could discount the revenue back and get an all-in present value number for the revenue, and then discount the expenses back and get an all-in number for the expenses and then the tax, and do the subtraction of the present value of those 3 numbers once calculated. So whatever is easier and simpler to do. And what we're going to show in the next video, we'll have a few different manipulations that we can do using discount factors, which is the very first table at the bottom of engineering economics, but I don't want to get ahead of myself. We're able to do things like find the present value of a cash flow that's in the future by multiplying by a number that comes from the interest rate tables. In this case, it's P given F based on some interest rate I and some number of years N. And we're going to be able to go between present values P, annualized values A, future values F, and one more that we haven't talked about or drawn here, which is gradients, G. And actually, this looks kind of like a gradient, and it probably could be modeled as a gradient. Although one slight distinction there is there's usually a 0 in year 1, and the gradient doesn't actually start to show incremental change until year 2. So technically, for this to be a gradient, we might have to manipulate it a bit, but that's getting into the details. We'll definitely cover that in some of the example problems. My main goal for you here is just to get a handle on the basics of drawing cash flow diagrams so that you have a starting point. That's going to be our baseline for solving a lot of economics problems.